So now what I want to do is to give a very brief overview of some of the problems with centralized finance, or CeFi. It's very brief because we will go through in much greater detail later in the course these problems one by one. But I want to introduce the problems. And what's the reason for this? You've got a new technology. The new technology, to be viable, has to solve problems. It's not particularly useful to solve a problem that doesn't exist, or a problem that might exist in the future. It's much more credible to actually address the problems that we deal with right now. And let me go through some of these problems. So there are 5 that I focus on. There are more, but these are 5 that are important. Centralized control, limited access, inefficiency, lack of interoperability, and opacity. Again, I just want to do an overview, and we will get back to each of these in much greater detail. So centralized control, our banking system is highly concentrated. It's interesting that it's not as concentrated as, let's say, in Europe or Canada, but it is concentrated. And our large banks have significant influence. So central national banks like the Federal Reserve or the Bank of England also have control over the fiat currencies. And there's concentration in other areas too. So there's non-financial centralization that you could argue is linked to finance. So Amazon and retail, Facebook, Google, and digital advertising. These are firms with enormous market power. These are firms that are, at least we know for one of them, Facebook, very interested in investigating cryptocurrency. It makes sense for them, given the amount of business that they actually do, that it comes down to a credit card. To save that 3% is a big deal. So limited access. And again, I'll talk in more detail about this, but there are 1.7 billion people that are unbanked. There's probably more than that are underbanked. So our financial system, even though it's been operating in its current form for a little over 100 years, a lot of people are left out. And as I'll go through a little later, this means that many entrepreneurs are forced to use a credit card to get financing for their business. And we know what those credit card rates are, like 20% or more. That can't be a good thing. So number 3 is inefficiency, and we've talked already about the 3% swipe. And look, don't fool yourself by saying, well, I don't pay the 3%. It's the retailer that does. Well, that's pretty naive, because that 3% makes its way into the price that you're actually paying, or part of the 3%. We talked about the inefficiency of a wire transfer, or the 2-day settlement when you buy a stock. That just seems unacceptable in the age of the internet. Transfer is slow, it's fraud. So credit card companies might say, well, we have to charge 3% because we need to spend that money on security. And we will guarantee if somebody steals your card and uses it, we'll pay you back. So you're not affected. There'll be a chargeback. So essentially, you're paying that 3% because they've got a flawed technology. You're subsidizing a flawed technology. There's also no possibility of microtransactions, which I'll talk about also. It's kind of interesting in this space. And it's also difficult to get paid. So we think of paying on the internet with a credit card is much more difficult to receive funds. There are some fintech technologies that are allowing people to do this, but those technologies largely use the centralized finance backbone. Lack of interoperability. So our institutions are highly siloed. So to do something really simple, like move some money from my bank to my Robinhood account, that's going to take 2 or 3 days. So let's say I want to buy something like a stock on Robinhood or some other broker platform, and I want to do it quickly. Well, it's really difficult to do quickly because I have to transfer the money using the centralized system, and it's going to take 2 or 3 days. So again, it is frustrating in the age of the internet that it would take so long to do this. So some of these companies recognize that this is a problem, and there have been efforts. For example, Visa attempted to acquire Plaid, and Plaid is a fintech platform that kind of links to make things more interoperable. But that, interestingly enough, that transaction was blocked by the regulators. The last thing is opacity. There's very little transparency. You go to the bank, you see one bank advertising a savings rate or a CD rate that is much higher than the other bank. Well, maybe they're doing that because they're in distress, that they're just risky. And it's really hard for customers to figure out the risk of the actual bank. And indeed, what we have to do is to rely upon regulation. So thousands of people that are inspecting the banks. So it's not out in the open. And that's what DeFi actually does. So I'm going to argue that these frictions, these problems, cause missed growth opportunities. This is very much related to some of my academic research. And the idea is really simple. The entrepreneur goes to the bank with a great idea, and it might be 25% return on investment. Very exciting idea. They need a loan, but the bank's not interested because the bank would rather deal with a very large customer rather than dealing with many small customers. And the entrepreneur might have a relationship with the bank, and the bank says, well, we will boost your credit limit on your credit card, and you can borrow the money on the credit card. And that rate could be 24%. So you think about it, the return on investment, 25, the cost of capital, 24%. What happens? The project is not pursued. And that is really damaging for the economy. So all economies need economic growth. Indeed, many economies are greatly indebted. So the amount of government debt divided by, let's say, GDP, for many countries is at an all-time high, or at least an all-time non-wartime high. And that debt needs to be paid back. So there are 3 ways to do that. And one way is to raise taxes. And we know that raising taxes is not going to be particularly stimulative for economic growth. Another way is just to print money. And we know how that turns out with inflation, which is a tax on everybody. But there's a third way. And the third way is increased economic growth. And we've been stuck in the US with a 2% growth rate. Europe is 1%. Japan is less than that, effectively zero. But if you have increased growth, then it's much more likely that you can pay back your debt without raising tax rates. So just the economic growth, the increased revenues are generating more tax inflow for the government to pay down debt. So this is really important in that the current economic system is basically locking us in to a low growth sort of environment. That the project that the entrepreneurs got that delivers 25%, that is the sort of project that we can boost GDP growth to 5%, 6%, 7%. But those projects just aren't profitable given the financial system that we've got. So the basic idea is that there should be equality of opportunity. And right now, we've got inequality of opportunity. So certain powerful firms get the best possible deals. And that just doesn't seem right on multiple dimensions, including the economic dimension. That projects should be financed based upon the quality of the idea and the soundness of the execution plan. So there are many other issues and that are under this rubric of inequality of opportunities. So many in the world have no access to the internet to do commerce, whether it's to buy or sell. So many of the unbanked. And this is also a big loss for economic growth. So where we're going is to establish a technology that is inclusive, that allows for equality of opportunity.